This is Covered Calls with Kevin Simpson, featuring expert insights and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Welcome, everyone, to Covered Calls. This is our podcast. I'm Kevin Simpson, your host. And if you're tuning in for the first time, I'm the CEO of Capital Wealth Planning. And my goal with this podcast is always to engage with the best and brightest minds on Wall Street. Today, I couldn't be more than excited to have the great Stephanie Link on. Stephanie is the Chief Investment Strategist and Portfolio Manager at Hightower Advisors. Most of you will recognize Stephanie from her work at CNBC. And before we get started, I just want to let you know that I'm personally a huge fan, and you're one of my favorite investment strategists on the network, and mostly because the rigor and process that you go through is so impressive. But even more than that, there's not a ticker symbol that someone can't throw at you that you don't know every single statistic about it. I mean, how do you do it?
Thank you so much. It's so great to be here. It's really called passion, right? We love what we do, and I just like to learn something new every day. And I stay humble because I'm aiming to be a 500 batting average investor. That would be great if I could, but we know that it's a challenge. But it's always fun to learn something new every day.
Well, you're the best at it. I mean, I try to do it in my own little space, but I can remember, 2 or 3 stocks inside and out, and I think that they throw probably 200 or 300 at you a week, and you seem to know everything about them. So I'm always impressed. And going back into your history, speaking of impressive, one of the things that I know our audience is primarily financial advisors. They watch CNBC a lot of Jim Cramer fans, and you worked with Jim as a co-portfolio manager at the Street for his charitable trust. Yeah. What was that like? Any good stories?
I have a great story about Jim. I mean, I could go on all day, but this one is something that is very near and dear to my heart, believe it or not. I think that Jim, while he does seem a little out there, I think that he is not that kind of a person when you get to know him. He has an amazing amount of talk about rigor and focus and energy that it was really a wonderful compliment to work with him, because I had just left the sell side and I wanted to try to learn about running money. And he is very, very good at managing money, believe it or not. And so we kind of ham and egged it. He was the momentum person. I was more of like the value core person. And so there are a lot of all capitals on emails through the years as we debated and discussed on emails. But the story I want to tell is when I met Jim, as I mentioned, I wanted to leave the sell side and see if I could run money. He was looking for someone to run his charitable trust, as you mentioned. And he actually, we met for 30 minutes. And after 30 minutes, he hired me on the spot. And by the way, that 30 minutes, he never asked a thing about me. He just wanted to talk about stocks and tickers and this and that. And so I accepted, and he said, take a month off. I just had my child. And he said, take a month off, enjoy, because we're going to hit the ground running come May 1st. So April 30th comes, and I decided, wow, I spent all this time with my newborn. I didn't think I could leave her. I mean, I always wanted to be a career person and a mom.
Sure.
And it was hard. It was hard that the night before. So I called him up and I said, on the night of the 30th of April, and I'll never forget it, I said, Jim, I can't come to work with you. And he said, and I thought he was going to slam the phone on me. And he said, why? He's like, what happened? I said, nothing. I just don't think I could actually work 5 days a week in the city and be away from my daughter. And he said, okay. He said, what is it going to take? And this is way before the Zoom days and the webinar days. And he said, what is it going to take? And I said, well, can I work home for 2 days a week? And he said, he goes, how about you work home 3 days a week and 2 days in the city? And that is the Jim Cramer I know, right? Like he just got it, which, by the way, working at home was harder than working in the city because it was 24/7. But he has a heart of gold, but also he's very, very smart and taught me a lot in terms of money management.
Interesting how we get to where we're going, and everything happens for a reason. And where you are now is just so awesome. You're with Hightower Advisors. We know Hightower. We work with a lot of advisors within the network. Tell us a little bit about Hightower, if you could.
Yeah, so Hightower is one of the largest independent wealth management companies with about 120 advisor teams and over $120 billion in assets under management. It's really a great place. It's almost like 120 entrepreneurs, and every one of the teams, they're different. And I've gotten to meet and know many of them, and they're very, very bright, and they really just want to do what they love to do. And many of them are really, truly some of the best wealth managers I have ever met. And so we are headquartered in Chicago, but I'm in New York, and of course we could do that nowadays. But we spend a lot of time out in Chicago too, but around the field and visiting them. And I run the Investment Solutions Group, which is it's really used to be called the OCIO. So it's outsourced CIO business. I call it the Investment Solutions Team just because I thought that not a lot of people knew what OCIO was. So what we do is we're a miniature asset manager within Hightower, and we have equities and fixed income, as well as multi-asset portfolios that we manage. And we also have an alternatives business as well. And so I oversee that group. And we're up to about $3.3 billion in assets under management.
That's fantastic. As you know, I'm an equity only manager, so fixed income isn't anything that I have a good expertise in, but our audience, the financial advisors that we work with, that we communicate all the time, are starting to get excited for the first time in a long time about fixed income. And I go back longer than you. So I remember when there were yields in bonds in days gone by and decades past. But it seems like for the past decade, it was just an effort of trying to squirrel money away, but not really make money. What are your thoughts on the fixed income side of things moving forward? Should advisors be excited about it?
Well, I'll tell you, I think this year has been an eye-opener, Kevin, because I think people expect, and as you're an equities person, people expect to lose money in equities every once in a blue moon. They do think, yeah, it's volatile, but over the long term, the average return, total return in the S&P 500 is about 7%. But you're going to have up years, you're going to have down years, and I think people can realize and reconcile with that. On fixed income, I think this year, people forgot you could lose money. And I think that's the biggest learning experience for them this year. And we all know why. We know why the markets are down overall, equities and fixed income. And that is because we have a changing of the guard with the Fed and with liquidity, mainly monetary policy changes, but also less fiscal policy implementation, right? We had an unprecedented amount of liquidity over the last 3 years before 2022. And in fact, if you go back to June of 2020, when we were at the height of the issues, we saw that fiscal and monetary policies that were put in place was 60% of US GDP. So to put that into perspective, the last recession, or in the great financial crisis, that in 2008, the fiscal and monetary policies, if you add it all up, was 5% of US GDP. So clearly we put in an enormous amount of money into the economy, into the system, and that helped us get out of the closures that we saw, right? And we had a V-shaped recovery as a result. Well, so you fast forward to this year, and now you have more of a restraint in liquidity. And so you have a dislocation in equities and fixed income. Now, I think up until this year, there was no alternative for the last 10 years. We've had zero interest rate policy in place for that long. And as a result, I think that this year, you actually now, especially on the short end, you could just hold the bond to maturity and collect 4% on a 2-year or 3.5% on a 10-year. And that's about as far as I would go. I know that there are some experts in fixed income that are starting to nibble at the long end, thinking that there's real value there. I think you can do it, but I would just say you want to have more like a ladder approach, if you will, on fixed income. But I do think the 60-40, which was dead because there was no alternative, that's now actually turned itself out right around. And I think that certainly it's an attractive allocation, if it's not 60-40, if it's 70-30, but there are options in the fixed income market these days.
Yeah, I think you make a great point, because we we remember back and reflect on 2008, and if memory serves, I think the TLT or the long bond was up like 25% that year. And here we have another down market, maybe of a different consequence, and you see fixed income go down. And of course, when you have rising interest rates, that's what happens. But
Sure.
it's that reality shock that sometimes we forget about. And you also make a great point about all of the money that's been stuck in or just pumped into the system. And it will take time for the monetary supply to be able to absorb all that, which means we might not have another really strong surging stock market of that free money trade. We may never see it again in our lifetime, but it's certainly not going to come around anytime soon. That seems like a pretty fair guess.
I think it's interesting. The last 3 years, not 2022, but before 2022, the 3 years prior, you had a compounded annual growth rate in the S&P 500 of 28%. 28%. People thought that was normal.
Yeah,
right?
and didn't it include like a 35% 3-week correction?
Exactly right. Exactly right.
About?
Right? Isn't that incredible, though? I mean, but I think, Kevin, I think people thought that was absolutely the norm. And I think people thought that they were great stock pickers. And by the way, a lot of people could make money when the markets are up 28%. You may not beat your benchmark, but you still felt good, even if you were up 20%, right? And so this year, that's why this year hurts that much more, because you've got an equity market that's down is where it is, and you actually also have fixed income. So you're getting the double whammy. It's not going to stay like this forever. And you know what? Even if we go into a recession, we're discounting a lot of bad news going forward. And remember, the equity markets, well, and the fixed income markets, they're forward-looking indicators, right? So we're discounting a lot.
Yeah, I share that optimism with you. Maybe not as much as some of your peers on halftime, but I think for sure the recession has to happen just based on the way I'm looking at markets and preparing the portfolio for it. But to your point, the market doesn't care about a recession. If you own great stocks with low multiples that make money and have profits, they're going to go up no matter what happens. So the fun that we're all having is, well, what's going to happen next year? What's the Fed going to do? What's the market going to do? What are your year-end forecasts? And it's great to talk about it. I think it's important to have, to be in the ballpark somewhat, so you've got some, credibility. But the reality is, and this goes for both you and I, we don't own the markets. We're stock pickers, and it doesn't matter what the stock market does, and it doesn't matter what the broad index is doing day to day. What matters is the stocks that we own within it. And when you were talking about that 3-year super cycle, it didn't matter. You could have bought anything and you would have made money. And now, now maybe we earn our stripes again.
I think we definitely earn our stripes. I mean, I know I've got a little bit more gray hair this year than the last 3 years. That's for darn sure. But
you keep looking better every day. I don't want to hear about it.
Well, thank you.
So talk to us, and I know we're coming up against it in terms of time, but if we want to have a little fun with the projection for next year, and we're not looking for incredibly specific, but just somewhat maybe more of a range for the S&P 500. I know I just said we don't care and it doesn't matter, but it's still fun to do at the end of the year. What do you think for 2023?
So I think 2023 is going to be the tale of two halves. The first half, I think, is going to be challenging, and I think we're going to stay in the trading range. I don't know, call it, say, 3,600 to 4,200, kind of a range. And that is simply because we just don't know what the Fed is going to do. We also don't know what the Fed has already done. What is it going to do to the economy? We know it's going to slow down. What is it going to do to earnings, too? So there's too many questions, too many unknowns. And I think we will get to the point, end of first quarter, maybe early second quarter, where the Fed does pause. And then I think if they pause and they just become data dependent and they keep rates high, though, because that's what they've said, any data point that comes out in terms of better inflation, better growth, a Fed that does, in fact, pivot, because I don't think a pause is a pivot. I think as we get that, the second half of the year, we certainly will be, I think, higher. Do we get to, the highs of this year, 4,800? Possibly. We could go even higher if the Fed does start to turn and reverse course and start easing. But I think it's too premature to tell. If you look at a CPI number today, it's way too premature to say the Fed is going to stop. And then they're going to immediately pivot. They're going to wait a while. They're going to wait to see if inflation can be sustainably to that 2 to 3% level.
Yeah, people don't understand that pivot isn't pause, and you bring up a great point. So pivot's not a near-term thing. It's probably a late 2023 thing.
Yeah.
potentially an early 2024 thing in my thesis, but we agree on everything else except we should have had this conversation next week, because then we would have had the most recent dot plots and we'd have a little bit more of a sense of where that terminal rate will go. And we can think about a multiple and think about what it's going to discount earnings. So I reserve the right for us to just not give too detailed an answer, but say that it will be highly dependent upon where that terminal rate is. Because what people sometimes also forget, because we've been in the super cycle and zero interest rates, is that multiples can't be at the levels that they were at 2021 when interest rates were zero. So when interest rates go up, multiples compress. I mean, that's what happened to Microsoft in 2000. It wasn't like Microsoft had all these problems. It was just multiple compression for year after year after year. And they finally, it had to grow into it. I mean, essentially that's what had to happen with the stocks. They had to grow into their earnings to get to their stock price. So
and you made a good point too, Kevin, in that this year it's been value over growth. And it's been it has not been rewarding to, on these kinds of days when you see a little bit of growth outperforming value. I just don't think you're going to see the value give up its gains. I think that's where you want to be, especially in the first half of the year. I've been leaning more towards value. I've been overweight energy, materials, industrials, financials. I'm starting to look at some of the home builders, just because I think longer term, I think that if we do get a pause pivot, those stocks are extremely cheap. But it may be a little bit early on that front. But I've been underweight tech for a while. I have started to buy some semiconductor companies in the last couple of weeks because they got too cheap, and I would call those value tech, to be honest.
Yeah.
So
I think you bought Lam. Did you buy Lam yesterday? I mean, this is evergreen, so no one's going to remember that.
I bought Lam and I added to Broadcom, and of course I own and I'm suffering with Meta. But that truly is a value, I think, over the long term as well.
We're all rooting for you, so you can stick it to Josh Brown someday on that one.
I've stuck it to him a couple of times over the years. Yes.
I love energy. I'm with you there. I like financials, healthcare. We still like consumer staples, but they've gotten expensive because people kind of ran there to hide. We've been adding to General Mills a little bit because we still think we own Procter & Gamble, but can't buy it at these levels. Even McDonald's, I look at the multiple there and I'm like, I can't add to this stock. And we've owned it for almost 10 years. It's ahead of its skis, I think, a little bit in terms of its valuations, but the dividends keep pumping out, the dividends keep growing. And that to us is a good way to navigate what we're all thinking is a little bit of an uncertainty, at least for the next 6 months, and things will get clearer. And I will leave everyone with some positive thoughts that we're much closer to the end of the Fed tightening than the beginning.
Yes.
And to Stephanie's point, we've got tremendous optimism for the latter part of next year, which for all the right reasons. And there's even, as you said so eloquently, there's even opportunities in fixed income. So lot to be thankful for as we head into the end of the year and the holiday season. Thank you so much for coming on the show. We all love you, the world, and can't wait to have you on next year and see what these predictions turn out to.
Thank you so much. Have a great holiday.
Thanks, Stephanie.
This message does not constitute an offer to sell or a solicitation of an offer to purchase securities through CWP Advisory Services. Investments are not guaranteed and involves risk of loss. The views and opinions expressed in this message are those of investment professionals made at the time this content was recorded, are not necessarily the views and opinions of CWP, and may change in time without notification. For additional information about CWP, visit CWP's or the SEC's website for a copy of our ADV disclosure brochure and Form CRS.